the Trump tax plan. There's been some hopes that have maybe been dashed and some hopes that maybe have been exceeded. And Nate's going to explain to you what has happened since the fourth quarter of last year into now, and into the degree of how things are actually being enforced. And I want to remind all of you that at any time, text us with your questions. We'll interrupt Nate and we'll get your specific questions answered. Then, as usual, I'm going to start this presentation with one of my YouTube videos. Let's talk a little bit about how to fail and wind up paying the state of California tax that you didn't have to do. By not hiring me beforehand, okay, of course, I'm arrogant, I'm confident. The reason I'm confident is if someone hires us before they take possession and follows all of our instructions through the test period that they've chosen to use, they're not going to fail, okay? Recently, I became aware of a case that a lawyer sent to me, said, can we help? And it's scary on two fronts. One of them is, why didn't the guy hire me? And I can tell you why he didn't hire me. He made a decision based on price. He found somebody that would do it for less money. And second of all, they gave way too much information to the state of California. Those are two very fatal things. The tax bill is over $1 million. So what the state of California wants is over $1 million in taxes, penalties, fines, interest, whatever their socialist viewpoint is to steal your money. But the bill is over $1 million. And it doesn't have to be. Too much information was provided. And I can tell you from my point of view, someone inside the state of California is misapplying their own historical records, and they're misapplying what's applied through the IRS, which has nothing to do, if you look into California laws and regulations, there's nothing about this particular viewpoint which I cannot divulge to you, okay, because it'll give them too much of a heads up. But they're doing it wrong. And my guess is they know they're doing it wrong. Why? Because they've been bullying people for years. And their answer is always, we've always been doing it that way. That's how the first functional use test was designed in the interstate commerce test. Someone just woke up one day and wrote something into life, and they say they've always done it that way. And I could prove to them that they didn't, but it didn't matter. It absolutely didn't matter. Whoever these people are, they can sit in their offices and just say, we've always done it that way, and you have to accept it. And as long as you know that the tax agency is willing to take that position with you, why wouldn't you protect yourself? You have to protect yourself. You have a duty and an obligation and a responsibility to yourself and your family and your company to not pay these taxes and fees to a completely corrupt government. That's my opinion, and I'm sticking to it. If you shop your tax consultant by price, why would you do that? You're going to spend $5 million or $25 million or $70 million or even $1 million on an airplane, and you're going to try to save a couple of $1,000s on your tax advice? It's, you know, unless you believe that you can finance the rest of your life by the amount of times you're going to win a lotto, it makes absolutely no sense. Absolutely no sense. And when you're dealing with a state agency like California, that at a whim, they'll change the way they look at information. Okay, and I guarantee you that happens every damn day. You have to understand how to communicate and how to deal with these people. And I will tell you that from my point of view, every aircraft that's had to pay tax was because of some information provided to the state of California by the taxpayer. So you have to understand how to communicate with them. You have to understand what information you're going to give them. If you take the viewpoint that they're going to shoot you and burn your house down and fuck up your wife and family and your kids and eat them for lunch Okay, you have to see that much danger in how all this stuff is. I'm not suggesting to you that anybody at the state of California would actually operate that way, but you need to get your mind right about how dangerous all of these interactions with any tax agency is. If you look at them like a voracious animal who wants to eat you, then you got to be more careful about what you do and how you communicate with them. You have to understand whatever their focus is, it's always got a common denominator regardless of what tax agency is. And that focus is they want your money. They think they're entitled to your money. They're socialists, okay? No capitalist would ever allow there to be any form of taxes, okay? That's just my opinion, but I'm always right. That's what I have to say, and now here's your opportunity to talk to someone who I think is one of the most brilliant aviation attorneys on the planet. He's done a lot of research for you to bring you up to date on how the IRS is applying the 2018 tax plan. So Nate, take it away.
Thank you, Tom. It's great to be here this morning. Always nice to do a webinar with you. And good morning to everybody else. Thanks for coming and participating. My name is Nate Pietila. I am a shareholder in Aero Law Group in Bellevue, Washington. We focus on aviation transactional issues, tax, and deal work involving business aircraft. It's primarily what we do. And we're coming up on, well, let's see, it's been about 10 months since this Tax Cuts and Jobs Act was signed into law last December 2017, and there's a lot in this bill, not just related to aviation. Obviously, there's lots of changes in tax rates and corporate tax and everything like that, but we're just going to focus on the tax implications for business aircraft owners and what changes have been wrought by the legislation. So feel free to type in a question at any time. You don't need to wait until the end, but Tom will stop me if there's a question, and I'll try to answer everything. I do have a fair amount of material, so if you think I haven't gotten to it, if I haven't gotten to your question yet, I might get to it later, so bear that in mind. This is a question we get a lot. Can I deduct the cost of my aircraft? And we have to explain to people it's not just a matter of setting up an LLC and putting an aircraft in it and voila, you're a business and you can deduct the aircraft. You've got to use the aircraft in a trade or business, and it's got to be an ordinary necessary expense in support of that business. So you have to ask yourself the question, for my business, do I have to travel by air? Well, lots of people travel by air for their business on the commercial airlines, so that's probably pretty easy to show. But can my need for air transportation only be met by private aircraft? And that's a little harder thing to do. And what we've seen in IRS examinations the past few years is that the examiners like to look at and try to throw out the aircraft expenses because it's an extravagant expense. It's not an ordinary necessary business expense. So you've got to be prepared to answer those types of questions with regard to the aircraft. Is it the appropriate size aircraft for the mission? Are you using it enough, or do you just buy a $60 million Gulfstream to do 2 trips a year to New York? You know, is it common in your particular business where you have, you know, all your business locations within 50 miles of each other? Why would you need a Gulfstream to travel on behalf of that business when it's all local? So those are the kind of things that you have to think about. And we've put together this list on this slide of possible arguments that you can make for the IRS to show that the aircraft was used in business. We can't risk the cancellation of a flight. We need to travel privately because you can't risk missing this meeting by traveling on commercial airlines, cancellation due to weather or pilot actions or missing a connection or whatever. There may not be airline service in the remote location that we have to go to, or there might only be 1 flight a day that's almost sold out most of the time. We need to work on board the flight while we're traveling to our meeting. We need to have security for executives and security for the information that we're discussing on the flight. We might have to do an itinerary that we can't do on the airlines, go to several cities in the course of one day. You can't do that on the airlines. You can go to one city one day when you're lucky. And allowing changes to your travel itinerary, that's much easier to do on the airlines, much easier to do on a business jet than on the airlines. So those are, you got to be prepared to make those arguments to the IRS that this is an ordinary necessary use of the aircraft. So that's kind of the threshold question that that you need to keep in mind when thinking about whether you can deduct your aircraft expenses. And you got to be prepared to make those arguments to the IRS if there's an audit that happens. So the Tax Cuts and Jobs Act has made a fair number of changes, and this first slide, kind of the first change I want to discuss, I mentioned that you have to use the aircraft in a trade or business in order to have it deducted. There's another, and that's ordinary necessary business deductions under Section 162 of the Code. There was, under the previous law, Section 212 of the Code that allowed you to deduct expenses for the production of income. This is a deduction only available to individuals, but it was expenses that were reasonably necessary or helpful to help you produce income. It wasn't necessarily a trade or business that you're in, but it was helpful to producing your income. Think of you've got a large portfolio of wealth that you have to keep track of and visit your financial advisors in New York or visit your passive rental properties in Texas, and they're not trades or business that you're in, but you've got a big portfolio of investments that you might be able to manage. So Section 212 allows you to deduct expenses for that kind of production of activity, production of income activities. One thing the Tax Cuts and Jobs Act did is that we no longer have those deductions under Section 212. So you've really got to show now, in order to deduct your aircraft expenses, that you're using the aircraft in a trade or business rather than just for producing producing income. Miscellaneous itemized deductions are the category that the Tax Cuts and Jobs Act no longer allows to be deducted, I think, until 2025. So it's temporary. They're supposed to come back, those deductions, but not for many years. And it's Code Section 67, subsection G, that does that. One thing I'd also point out is that unreimbursed employee business expenses. Say you're an employee for a company, but you decide to use an aircraft, or you can make the argument that you have to use a private aircraft in order to perform your business, your trade or business as an employee working for a company. You're not getting reimbursed by your employer for the aircraft, but assume you can make the argument that the aircraft is an ordinary necessary expense for you being an employee. It allows you to commute from to various places. Unreimbursed employee business expenses are another miscellaneous deduction that are disallowed under the new tax law. So the avenues for deducting your aircraft have narrowed a bit under the new tax law.
Nate, this is Tom. Let me go back to that other slide.
Sure.
Where you're looking at the production of income deduction, the Section 212 being removed, does that mean if someone has a portfolio of multiple businesses and he's traveling around merely managing those businesses, that those are no longer business deductions, or you cannot deduct the aircraft?
No, I'm not thinking those businesses that you actively manage. I'm thinking of, like, you've got a large passive stock portfolio or portfolio of bonds or something like that, or literally purely passive real estate activities that you don't participate in. They're just investments that you have. The managing your investments, looking after your wealth type of activity is what 212 is aimed at. You can still deduct you can using your aircraft if these are if these are trades or business. You're using the aircraft in connection with the conduct of these trade or business. But that's a good question. Yeah, 212 doesn't come up. 212 is a deduction only available to individuals. It's not available to entities, companies. So you have to bear that in mind. It depends. It depends. A lot of people don't use 212 that often, but it is worth pointing out if you're looking for an avenue to deduct your aircraft expenses, you don't have the 212 deductions anymore, and you don't have the unreimbursed employee business expenses anymore.
Okay, I have another question for you. If an employee has a personal aircraft, that employee cannot expense the use of the aircraft to the employer?
The employee, well, there are, leaving aside the FAA restrictions on getting reimbursed by your employer for using your own aircraft, discussion topic for another webinar. You can get reimbursed by employer, assuming it's legal under the FAA regulations to get reimbursed by an employer. Yeah, that would be reimbursement to you, and that would potentially allow some deductions of your aircraft expenses. But the reimbursement might be so small, and there might be other limitations that would not allow you to do anything but deduct, offset the income from the employer in terms of expense reimbursement against your other expenses. So yeah, it doesn't impact any reimbursement you would get from your employer, but I'm talking about unreimbursed employee business expenses. If you're an employee and you just fly the aircraft in connection with your job, to do your job, and it's unreimbursed by your employer, those expenses relating to the aircraft aren't deductible anymore.
Okay, thank you.
Sure. So bonus depreciation actually has been expanded under the Tax Cuts and Jobs Act, and it's a big thing. And so I want to go into that a little bit, and I'll start by discussing what is depreciation. And there's kind of three very different types of depreciation that we need to distinguish among. One is market depreciation. That's what my aircraft is literally worth in the open market over time. I pay a price to the manufacturer when it's new. What can I sell that aircraft in the used market for over time? And as that value goes down, as the aircraft gets older, that reduction in value is market depreciation. That's what we call market depreciation. It's what the asset is actually worth. Book depreciation is purely a financial accounting estimate, and it's usually errs on the conservative side. A company buys an aircraft, puts it on its books as an asset, and then it takes depreciation because these aircraft don't last forever. They have a certain useful life, but the financial accounting people say, okay, I've got this aircraft, I think it's going to last 20 years, and at the end of 20 years, it's going to be worth 10% of what I paid for it. So that's book depreciation. You charge, on every annual financial statement some depreciation of the book value of the aircraft. What we're talking about today is tax depreciation, and it sort of it really doesn't have any basis in reality. It's really what the tax code says. Okay, you've got this aircraft that you're using in your trader business. How are we going to allow you to recover the cost of that asset and offset it against your business income? That's tax depreciation. So it allows you, if you're using your aircraft in a trader business or for the production of income, you can take depreciation. Now, as I said in a few slides before, production of income deductions, 212 deductions are gone, so we don't have to worry about that. So we're just talking about trader business deductions. So it's the idea is to reflect the reduction in value of the property over time that's used in business, and to sort of match the tax deduction to the income that the asset produces. But under bonus depreciation, or I'm sorry, tax depreciation, it doesn't really relate to the actual life of the aircraft. For general business aircraft, they're depreciated over the 5 years. 5-year maker's accelerated schedule or the 6-year straight line. And obviously these are 20-year assets or something like that, so they're greatly accelerated in terms of depreciation. And for aircraft primarily used in commercial operations, it's 7-year makers or 12-year straight line. So again, these are accelerated depreciation systems, so they don't reflect basis in reality. So if business is your predominant use, just regular use in your trader business, you use your 5-year makers or a 6-year straight line. If your predominant use is charter at 7-year makers or 12-year straight line. And there's a convention that extends the depreciation schedule by a year. You only get to take, depending on where you place it in service during the year, you might have to use the mid-year or the mid-quarter convention. So bonus depreciation, what the Tax Cuts and Jobs Act did was give us 100% bonus depreciation through the end of 2022. Now, when I say bonus depreciation, it's not really additional depreciation. You can still only depreciate the actual price you paid for the aircraft. But what the legislation says is that you can deduct it in the first year, all of it in the first year. And we've had bonus depreciation since, I think, 2002. It's never gone away, but the percentage has changed over time. Sometimes it's been 30%, sometimes it's been 50%, sometimes it's been 100%, but it always previously had applied only to new property. You had to be the original purchaser and user from the manufacturer in order to depreciate it. But under the Tax Cuts and Jobs Act, now it can be applied to used property. And bonus depreciation is also available to capital improvements that you might make to your aircraft, new engines, new avionics, and regardless of whether those engines or avionics are new or refurbished or used. So this is a very big deal under the Tax Cuts and Jobs Act, its extension to used property. Now you have to be careful that if you or one of your affiliates previously had a depreciable interest in the property, whether or not you previously depreciated it, but if you had a depreciable interest in property, these are new under new regulations that the IRS just proposed very recently. As long as you didn't have a previous depreciable interest in the property, you can take bonus depreciation. So that's to prevent people from, selling the aircraft on day one and then buying it back on day two just to get the bonus depreciation. They don't want people to turn their assets, turn them over in order to get bonus depreciation. One thing you have to watch out for and be careful of is whether you can convert property that you use not in business, that it was just personal use property, but then you move it over into your business. It is potentially available for bonus depreciation, but you have to watch out if you acquired the aircraft 10 years ago and it's been a personal use aircraft. If you convert it to business use, you don't get bonus depreciation, but depending on when you acquired it, even if it was previously personal use aircraft, you might be able to take the bonus if you use it in business. A couple other things on bonus. You have to remain eligible for accelerated depreciation during the entire 5 or 7 year maker schedule. You've got to have enough business use. You just can't use it all for business in 1 year and then stop your business, because then they'll recapture the bonus depreciation in future years. So that's one thing to watch out for.
Nate, I have a question for you.
Go ahead.
If a guy buys an airplane, say for $20 million, and takes the $20 million depreciation in the first year, what are the continued use thresholds that he has to maintain so he doesn't involve himself into recapture for portions of that?
Right. I think I have a slide later on that talks about Section 280 capital F, and it talks about for listed property like aircraft, you have to have at least 50% qualified business use, and that's use in a trade or business, and then certain types of business use, only count sometimes or in certain ways. So it's kind of technical, but you've got to have, the basic rule is you've got to use it more than 50% of the time in a trade or business.
On an ongoing basis, on all the years afterwards, even though you've already written it off.
Depreciation schedule years, yeah, that's correct.
Okay, got it.
And for the state of California, California has a high income tax, as we know. You don't get bonus depreciation. You just depreciate it under the regular makers or ADS schedule. And this is the key date under the legislation, September 27th, 2017. You only get bonus depreciation for property acquired after that date. So there is kind of a windfall for taxpayers. If you bought it after that date and placed it in service in 2017, you've got to take depreciation against the higher income tax rates that were in effect for 2017 that didn't go into effect until 2018, so it's kind of a windfall there. One thing that the legislation says is if you had a written binding contract in place on or before September 27th, 2017, then they don't treat it as you acquiring the property after September 27th. So that's something, I know everybody's filed their income tax returns for 2017 already. The extension date just passed a couple weeks ago. But that's something to think about. Maybe if, oh, I took bonus depreciation, but I really weren't quite allowed to do it because because of when I signed a contract for it. You'll want to think about maybe amending your return in that situation. The IRS is going to hopefully provide some clarification on what a written binding contract is. We know what it was in the previous regulations, but the NBAA has submitted comments to kind of loosen that definition a little bit, so we'll see. And again, that last bullet there, if you acquired personal use property before, September 27th or before, but placed in service after that date, you don't get bonus depreciation. So watch out when you're converting property you already owned to business use and trying to take bonus depreciation. Here's kind of an interesting wrinkle that came up a few months ago. If you're an auto dealer or a boat dealer or a farm equipment dealer, you don't get bonus depreciation if you have floor plan financing for your inventory, which is extremely common. I can't think of an auto dealer that doesn't have floor plan financing. So if you're an auto dealer, watch out. Also, if you're using the aircraft primarily using it primarily in a trade or business that provides regulated utility services, then you don't get bonus depreciation. So those are a couple of those industries were provided other benefits for the tax code, so they took bonus depreciation away. So any auto dealers on the phone on this webinar, pay attention to that. So here's basically the bonus depreciation schedule. We have 100% bonus depreciation until the end of 2022. And then in 2023, 2024, 2025, 2026, it goes down in 20 percentage point chunks, 80% in 2023, 60%, 40%, 20%, and then no bonus depreciation in 2027. But bear in mind that under previous legislation, going back 16 years to 2002, they've always extended bonus depreciation in some form or another. So hard to say what actually is going to happen, whether this schedule is going to stay in place or they're going to keep 100% or keep 50% or whoever knows. There are some ways for if you sign a binding purchase agreement before the end of 2022, you can still get 100% bonus if you place it in service in 2023 for certain aircraft. And that's true, going down the schedule, that's what those dotted lines mean. If you sign a binding contract for a certain aircraft and you place it in service the next year, you get the previous year's percentage of bonus depreciation. So that's a nice little feature. You have to be careful to fall into the definition of certain aircraft. It's got to cost more than $200,000, have a production period in excess of 4 months. 4 months, you have to make at least a $100,000 non-refundable deposit. So it's pretty easy to qualify for if you've got a jet or a turboprop. If you've got a really light aircraft, you're probably not going to comply with that. There's also an exception if it's not a certain aircraft, if it qualifies as transportation property used in the trade or business of transportation, you can deduct a certain part of the depreciation. So that doesn't happen. I haven't seen many clients rely on the transportation property exemption over the years, so it probably doesn't apply. One thing with the written binding contract is you have to think, who's it binding on? Is it binding on the seller or the buyer or both? It seems under the previous regulations that very often new aircraft purchase agreement have liquidated damages provisions. So if the buyer breaches, he loses his deposit. But in new aircraft purchase agreements, the manufacturer typically has very little, if any, damages if they breach. They usually just have to give you your deposit back and they can walk away. So there's an issue under the previous regulations whether if there's liquidated damages, a forfeit of the deposit, or if the manufacturer only has to give you back your deposit if they breach. Is it a binding contract? And it seems under the previous regulations, you had to have liquidated damages of at least 5% for the seller, in addition to liquidated damages of at least 5% for the buyer. but I think I mentioned this a couple slides ago. NBAA submitted some comments asking that the seller not be considered to, to have 5% liquidated damages at risk, because that's just not typically done in new aircraft purchase agreements. We've argued that issue with manufacturers and got them to put it in there, but it's really not common. Again, here's a chart just showing the difference between 5-year maker schedule and 100% bonus. You get the same, a $3 million purchase price aircraft, you get to depreciate the same amount, you just get it earlier. So it's really kind of a present value calculation. It depends on, what your cost of your money is and what tax rate you're paying. If it's a 4.5% cost of money and a 35% tax rate, your net present value savings is only about 2.6% of the value of the aircraft. So it's not millions and millions of dollars that you're saving with bonus depreciation. It's usually just a small percentage of the purchase price. If your tax rate goes down to 21%, like it is now for corporations, the value of bonus depreciation goes down as well. So instead of 2.6, it's now 1.6% of the value of the aircraft. So it all depends on your cost of funds. It all depends on your tax rate, depending on how valuable bonus depreciation is for you. So you got to get out your green eye shade and figure out, is bonus depreciation really worth it? There may be some circumstances where you might not be able to take advantage of bonus depreciation. So, your tax rate in the first year, in year one, where you take the 100%, you might not be able to write off your bonus depreciation against other income. And we'll get to this in a few slides. There's under the Tax Cuts and Jobs Act, there's now a limitation on individuals on being able to deduct excess business losses. Those get, and I'll go into that in more detail in future slides. So you may get this bonus depreciation, but then you might not get to take advantage of it until future tax years. So that's something to think about. If you're leasing the aircraft or chartering the aircraft out, you might be subject to the passive activity loss limitations. So if that aircraft is really a passive activity, that leasing, you don't get to use that bonus depreciation. If it creates a passive loss that you can't group with other losses, that passive loss gets carried over into future years, so you effectively don't get that bonus depreciation in year one. And as I previously mentioned, if your business use falls below 50% in future years, you get to recapture the excess bonus depreciation. So that's a gotcha as well. So you have to plan very carefully and see if is bonus depreciation, it's something to get excited about. It's a nice benefit, but can you really take advantage of it? And that's a deeper question. So again, bonus depreciation, not worth millions of dollars, just a small percentage of the purchase price. There may be certain taxpayer situations, involving rates, or if someone really needs, has a liquidity problem and the cost of funds is really high, right? They just can't borrow money, but they need this depreciation somehow. There may be special situations where it's worth a lot more to taxpayers, but you've got to be careful in thinking about that. We've seen bonus depreciation, people that take it, kind of raising red flags with the IRS on their tax returns because it creates such large losses and large deductions. Previously it was just applied to new property, but now it's even applies to used property, so it's probably harder to figure out which taxpayers, are maybe abusing bonus depreciation or taking it when they really can't. So it's hard to say at this point whether it's really a red flag if you take it on your tax return, because everybody is taking it now, or everybody is eligible for it. So stay tuned on that issue. One thing you have to watch out for is if you're using the aircraft for personal entertainment use, you may get your bonus depreciation may be severely limited. So it's actually section 274E2 of the code that says if you're using an aircraft to provide entertainment to a specified individual, and I'm talking about C Corps, S corporations, partnerships, people that have a 10% or greater interest in the entity, are an officer or a director, things like that, higher ups in the company. If they use it for entertainment purposes, then the depreciation is an expense that gets disallowed based on the pro rata percentage of that entertainment use. And the regulations and rules for computing the disallowance are pretty complicated. It's regulation 1.274-9 and -10. Entertainment disallowance is a very broad subject that we could spend, several hours on just in and of itself. But one thing to point out here is if you have personal entertainment use, the regulations, specifically 1.274-10b3, allows you, for purposes of entertainment use only, to assume that you're depreciating the aircraft on a straight line basis. So, and if you assume that, let's say you have some entertainment use in year one, but under the regulations, the amount of depreciation you have is just 6 year straight line depreciation. So you just do your disallowance calculation based on that depreciation amount. But the regulations say in future years, the depreciation subject to disallowance is the lesser of your actual depreciation or the straight line amount. But if you take 100% depreciation in year one, you don't have any depreciation in future years. So you don't have any disallowance for entertainment use in future years. So if you make this election for a business aircraft, not an aircraft primarily used in charter, if it's a business aircraft and you're using 6 years straight line, assume it's all personal entertainment use, only 1/12 of the cost of the aircraft would be subject to disallowance. So it's a nice feature of the regulations here, and this is a real benefit of having the 100% bonus depreciation, is that it allows you to take to avoid losing depreciation for entertainment use. So it's an interesting benefit there.
Nate, I have a question for you from several people. They want to know if we can send them the slides. Can we make your
Yeah, absolutely.
Available after? Okay.
Stop touching my slides, Tom. You skipped me forward a bit.
I'm sorry. My whole screen went black, so I couldn't see.
It's fine. No, your mouse finger twitched. So I promised that we'd get to Section 280 capital F. And the reason Section 280 capital F is important is because to qualify for bonus depreciation, you have to qualify for maker's accelerated depreciation. And what Section 280 capital F says, to qualify for listed property, and that includes aircraft, modes of transportation including aircraft, for listed property, to qualify for makers, you have to have at least 50% qualified business use. And qualified business use is using it in a trade or business, not for the production of income, but using it in a trade or business. Now, I mentioned production of income deductions are lost under the TCJA. But you've got to use it more than 50% of the time in trade or business use. And there's actually two tests under 280F. There's a 25% test and a 50% test. And this comes up in situations where you might be leasing the aircraft to a related party, or there's too much use of the aircraft used for personal use by a 5% owner, or too much personal use by other 5% owners. Or you don't impute them the appropriate income tax for that fringe benefit. So you can use that leasing and that personal use as qualified business use, provided that you have at least 25% of your use being just straight trade or business use, not leasing use, not personal use. And if you meet that 25%, then you can use these other categories, this leasing and other things, to get to the 50% threshold to meet it in. We could probably spend another hour or two on the complexities of 280 capital F, but it's in the statute. It's something that doesn't come up that often because it's transportation property and aircraft. It's a code section that not everybody deals with all the time. So you really got to plan when you're purchasing an aircraft. You got to be eligible for makers, like I said, for the whole depreciation schedule, so you avoid recapturing the bonus depreciation. And the definition of qualified business use under 280, you got to make it you qualify during each particular year. One thing folks worry about is if you're using the aircraft primarily outside the United States, or leasing it or using it, through a tax-exempt entity. Those are two types of situations eligible for maker's depreciation. You have to use straight-line depreciation. But there may be some relief under the proposed Treasury regulations that say if you qualify for makers and bonus depreciation year one, but the only reason you don't qualify for makers in year two is because the aircraft becomes used by a tax-exempt entity or becomes primarily used outside the United States, you don't recapture the bonus depreciation. So that comes up sometimes, but probably pretty rarely for this audience. So stay tuned on that one. This is an interesting portion of Section 280F. They call it the leasing company trap. So suppose you set up a company to own the aircraft, and then it leases it to a related company, which sometimes happens, and they're separate taxpayers. Sometimes that happens sometimes that happens in structuring. They set up a separate leasing company for aircraft. Now, as I said, if you're leasing the aircraft to a related party and you don't have any other trade or business use, you can't use that leasing of the aircraft on its own to meet your 50% use in a trade or business. So you have to be really careful that, oh, well, I set up an entity to hold the aircraft, an S Corp or a partnership, and I'm leasing it out. And so because I'm leasing it out, 100% of the use of the aircraft is business, so I don't have to worry about 280F. Well, so I don't have to worry about 280F, but 280F says that this leasing activity isn't by itself a sufficient business activity, so you've got to watch out for that. You've got to have some other trade or business activity. So pretty complicated, so you're going to watch out about that. One thing that, another thing that happened under the Tax Cuts and Jobs Act, there's no more 1031 exchanges for personal property. You still have it for real estate, but not personal property. So this is what makes bonus depreciation more important, because if you sell an old aircraft, a used aircraft used in your trade or business, and your basis in the aircraft is less than what you sold it for, because you were depreciating the aircraft, you're going to have recapture on that gain there. And so you have to pay tax on that gain there. It used to be under 1031, you didn't have to pay tax on that gain if you acquired a replacement property under 1031. Now you have to pay tax on selling that old aircraft, and the only way to offset that, not the only way, but a good way to offset that is to take bonus depreciation on the new or used aircraft that you're acquiring. There's a little bit of a whipsaw coming up in 2023 where bonus depreciation, as I mentioned before, starts to go down in 20 percentage point chunks. So you still have 1031 exchanges were permanently repealed, but bonus depreciation starts phasing out. So if the law doesn't change, now and 10 years from now, we don't have 1031 exchanges, so you've got to pay tax entirely on your disposition of a used aircraft that you used in your business, and then you have to start over depreciating the aircraft again. So that can be a painful realization thing for you. I'm getting. These are all, I think these last two slides are kind of the really new stuff that the Act introduced. One is Section 461L, which limits deductions for individuals for excess business losses. And EBL, excess business losses, are defined as losses from trades or businesses of the individual or that individual's allocable share of losses in trades or businesses of S corporations or partnerships that they participate in. So what basically happens is, if as an individual, you are only limited to taking excess business losses of $250,000 if you're a single filing taxpayer, or $500,000 if you're a married filing jointly taxpayer. So you might have an aircraft in an S corporation business, and you take bonus depreciation, which maybe not only wipes out all your income from that S corporation, but creates a huge loss. In that circumstance, you can only take that loss against $500,000 of your other income, and you can't carry it back to previous tax years. You've got to carry it forward into the next tax year as a net operating loss. So this EBL limitation it could really, depending on your structure, impact your ability to take bonus depreciation the first year. It used to be that you could take net operating losses and carry them back a couple years and carry them forward, a few years. But now with this excess business loss limitation for trader business losses, you've got these severe limits. The good news, I guess, is that if you can't take it this year, you can carry it over to the next year. It becomes a net operating loss. And net operating losses now, you can deduct them against up to 80% of your taxable income. So it's really kind of a timing difference. You don't get bonus depreciation the first year, but you have to use that loss to offset other income in future years. And another change of law, you can't carry back to previous years' net operating losses. So that's another change of the law. So this could have a major impact on people's ability to take bonus depreciation if they're buying a really expensive aircraft and it totally swamps any revenue that the business has and creates a big tax loss for them. Another thing that happened is changes to hobby loss deductions. A hobby loss is, the IRS doesn't allow you to take losses from activities that aren't engaged in for profit. This is Section 183. It's been in the code for a while, for quite a few decades. Sometimes it comes up when aircraft are housed in a single purpose entity that really never makes a profit, and it just always throws off losses. And it can be challenging to group that activity with other active businesses to argue that, well, the whole thing is not a hobby, the whole thing is a real business. But as I mentioned, the Tax Cuts and Jobs Act basically got rid of miscellaneous itemized deductions, and deductions from hobby losses are non-deductible anymore. So it used to be that you could deduct hobby losses or deductions against hobby income, but now you can't even deduct your expenses of engaging that hobby against hobby income. So really what happens is that you end up with a gross income tax on your hobby income. You get no deductions. So that's a really big thing, and you really want to try to avoid charging any of your activities as a hobby, because it's so painful with a gross income tax these days. I think I have 2 more slides here, and it's probably a good time to run through questions after I'm done here. But there's been some changes to entertainment disallowance under 274. It used to be that if you could deduct expenses for entertainment, or 50% of those expenses for entertainment, I believe, if your entertainment was directly associated with a business meeting. Like you take customers to Aspen and they go skiing, but you also have hours of business meetings in there that are directly related to that. Now you can't deduct those entertainment expenses, and that may have an impact on people that use aircraft for those types of business entertainment activities. So that's another change there. There's also 274, the 274I or 274J, one of those that got added to the code, that says if you are expenses used for providing transportation to an employee between his residence or his place of employment, you can't deduct those. So I mentioned a few slides ago, 274 entertainment disallowance for entertainment use by specified individuals. This statute kind of makes it look like they're going to be treating commuting between a residence and a place of business as entertainment. even if it's not entertainment, right? You know, it's just a place you live, it's just a place you work. It's not entertainment. You're not doing entertainment activities, but you might disallow the deductions as if it were entertainment. So we don't have guidelines from the or regulations from the IRS yet on what this section exactly means. Does it apply to um, primary or secondary, any residence of the employee, any place of business of the employer? Does it apply even if we impute income to the employee for that perk of traveling between his residence and work? What does it mean to that it's deductible if it's necessary for the safety of the employee? Do you have to have a safety or security study done? Do you have to require that they use the company aircraft to travel personally? There's a lot of unanswered questions there, but it's an interesting change there that you commuting on a business aircraft, if you're providing that perk to your executive, it used to be pretty much fully deductible so long as you imputed income to the executive, but now it appears not to be deductible in the most part. And last situation, we've got new section 163J that limits the deduction for business interest. So basically, your business interest deductions are limited to the amount of business interest income you have, plus 30% of your adjusted taxable income, plus any floor plan financing interest. And floor plan financing interest, as I mentioned before, is if you're an auto dealer or a boat dealer or a farm equipment dealer. So so they reduced corporate tax rates, but in exchange for reducing corporate tax rates, they limited the amount of business interest that you can deduct because they don't want people really highly levering their companies and getting large interest deductions. You can carry over excess interest deductions to future years, but it's an interesting limitation. If you have your aircraft, for example, in like a separate S corporation or a partnership, and you've got a loan on the aircraft, those interest deductions may be limited because entity that owns the aircraft doesn't have very much income. So that's something to really watch out for. And it also gets worse if you until 2022 you don't take into account tax depreciation in determining what your income is and determining that 30% limitation. But after 2022, you have to take into account depreciation, and so your taxable income is smaller. So 30% of that small number is going to be smaller. So your interest deduction is going to go down. So there's some very interesting limitations: excess business losses, limitations for employee commuting, limitations on business interest deductions. Limitations if you're an auto dealer on bonus depreciation. There's a lot of benefits in the Tax Cuts and Jobs Act, but there seems to be a lot of traps for the unwary. So I hope I've covered some of the things that you were interested in. That's what we know right now. There will be some developments as regulations come out from the IRS, but I'd be happy to take any questions that you have.
I do have a question for you that came a little bit earlier. It said, when we were talking about binding contracts, the question is, does force majeure eliminate binding?
No, and that is addressed in the regulations as long as it's a condition that's outside of the control of either party. If there's a force majeure event that prevents you from performing the contract, it's still a binding contract, I think.
Okay. We're still encouraging anyone who has any questions to send them in to us. It's your time to talk to one of the most brilliant attorneys on the planet when it comes to aviation stuff, and that's why he's here for you.
I do want to make a disclaimer here. Made every effort, obviously, to be accurate in the presentation, but the law and regulations are so technical that unless we're engaged formally for a particular set of facts and circumstances and really drill down into the regulations and how they might apply to your particular situation, this isn't legal advice. It's just meant to be educational and to get folks thinking about what's happening here and get them to spot the issues. So appreciate your attention. And if you have any questions, call me anytime.
I do have a question just came through.
Sure.
It says, does source of funds affect bonus depreciation?
You mean if they're borrowed funds or not?
I'm just reading you the question as I see it. So whoever asked that question, please respond to what Nate is asking you.
Yeah, well, I mean, if you borrow money to purchase an aircraft, you still should be able to get bonus depreciation. Now that gets tricky with an S corporation because if the S corporation borrows funds, the shareholder of the S corporation doesn't get basis in his stock that he can use to absorb the depreciation deductions. That's called the basis rules for S corporations. So if you're doing a loan on an aircraft, you typically have to structure it as a back-to-back loan, a loan to the shareholder who then loans it to the S corporation in order to get basis in your shares. But if you're talking about a multi-member LLC or a partnership that borrows money to acquire an aircraft, yeah, that the basis in the aircraft does include those borrowed funds, and you can take bonus depreciation.
Okay, the person who sent that question clarified it by saying ordinary income, sale of business, sale of stock, etc.
Oh, in terms of what you can offset the depreciation against. I mean, it all depends on what taxpayer entity is using it. Like I mentioned, if you've got an S corporation that buys the aircraft and takes bonus depreciation, and it absorbs all the income of that S corporation and kicks out a big loss to the shareholders on the K1, those excess business losses are subject to the excess loss business limitation, $500,000 a year for married couples, $250,000 for single filers. And so you can only use $250,000 or $500,000 of that money to offset against other taxable income. So that would be an example where bonus depreciation, the benefit of it may be limited for you. It all depends on whether you're an individual, taxpayer, corporate taxpayer, how the structure works. There may be some of those excess business loss limitations. There may be passive activity loss limitations, right? If you're using the aircraft primarily in charter or leasing to outside parties, leasing is a passive activity. And if that activity generates a loss, you can only offset that passive loss against other passive activity income. And not many people have, purely passive activities that they can, income that they can absorb those passive losses with.
We have a new question. It says, how does IRS look at deduction of aircraft expenses on business aircraft when donated to transport personnel for 501c3 as relative to depreciation issues?
Right. Yeah, we get that question a lot. Actually, I was talking to a client yesterday about that issue. The charitable regulations allow you to deduct, out-of-pocket expenses, incurred in connection with charitable activities. So if you fly the aircraft, to go visit, to go to a board meeting of the charity that you're on, you might be able to deduct those out-of-pocket costs for that particular trip. But what happens is, the rule has been this way for a long time, that you can't deduct fixed expenses related to your aircraft as charitable deductions. So it's kind of a bad thing, if you fly your aircraft for charity, you get to deduct the out-of-pocket expenses for the trip, but some of your fixed expenses might have turned from business expenses into fixed expenses related to that charitable activity, and they're no longer deductible. So you still get to deduct for the operating costs, but then you lose some deductions for the fixed expenses. There are some ways around that depending on how you're structured as a taxpayer or not. But yeah, unfortunately, that's NAAA has been trying to get the IRS to change the rule on that, to at least allow taxpayers who are otherwise using the aircraft in business not to lose fixed expense deductions if they use the aircraft for charity.
Okay. Someone just sent a comment, which was excellent presentation and update on tax matters. Thank you. Good overview. We'll refer a buyer to Aero Marine and Nathan Pietila. Hope we will be able to have a copy for our referral. I presume he's asking about a copy of your PowerPoint, and I would love you to move the slide notch one more so everybody can see where your phone number is so they can contact you.
Yep, there we are. We're in Bellevue, Washington. Don't have the Newport Beach anymore. I need to update that business card, but West Coast time. And we're in California a fair bit. We've got clients in the Bay Area and Southern California, so we're down there a fair bit. So I'd love to hear from any of you. Thanks for your attention. And whoever made that comment, your check's in the mail.
All right, that is the end of today's presentation. Thank you for all of you attending, and thanks to Nate for all the time it took to get this all put together for us.
Absolutely. Thank you, Tom. Thanks, everyone.